Why is the bond market not selling off when we have record deficit? I want to discuss this topic. This is the Not Even Wrong podcast. It's September 1st, 2020. This is Krim Delco. Today, the fund is down 14.5%. The market is up 75 basis points. For the year, we are now up 236.5%, and the market is up about almost 9%. So we're outperforming by 227%. So if on January 1st, 2020, you put $100 in the S&P 500 and you put $100 in Orange Capital Partners, Orange Capital Partners would have delivered by now roughly $337, 336.5 to be precise, and the S&P about $109. So this is what it means in actual dollar terms. Let's jump into it. I think the biggest event in the last definitely in the last couple of weeks, one of the biggest events in my humble opinion, one of the biggest events in the last, for a generation of investors, was last week when Jerome Powell, the Fed chair, announced that the Fed is going to average inflation targeting. So it's a change in regime. It's a change in the philosophy of the Fed, the way the Fed thinks, the way the Fed acts, the way the Fed executes monetary policy. And the change might sound like a little bit academic pedantry, just a little, thing that nobody really cares about, which is we're going from a fixed inflation target to an average inflation target. But what it actually means in real terms, meaning in real, actual reality terms on the ground, in your portfolio, as a portfolio manager, you need to pay attention to this because it opens up the gates for the Fed to be more accommodating with the markets than people expected before. This is the fundamental change, and this is part of the reason why we have a rally in the market. And the goal actually of the Fed is to support asset prices. The idea of the Fed is that if we have asset prices going up, we will eventually get to inflation. And if the Fed wants inflation because there is now a higher risk of deflation than inflation. What that means in reality terms is simply that you have prices in the economy, housing prices, asset prices, prices of cars, prices of things, and they are expected to decline. That is deflation. So they can become cheaper in the future. You can get with less dollars you can buy the same thing. This typically happens when there's an oversupply. There's not enough money in the economy. There's not enough demand. Things like that. On the other hand, inflation is when you have a certain amount of goods and then there's more and more demand for those goods, which ends up creating higher prices for those goods. That would be inflation. We are right now in the risk of a deflationary period, driven primarily by the COVID-19 crisis. However, lots of people, including me, would argue that this trend has been going on even before. This is not something which just happened after COVID, because we had already before that inflationary pressure. So this is the outline where we stand right now. This is where we stand. Now, what is going on? We have a situation in the macro in the US, which is we have near zero interest rates, near zero nominal interest rates. The 10-year bond is 70 basis points, and the 30-year is 1.5%. This is record lows. We've never, in many generations, actually never, ever, since the existence of treasury markets, had such low rates. So this is number one. Number two, we have record high deficits. So we have record high deficits and record high debt to GDP, or anything you want to measure. Debt to GDP ratios typically is a good ratio to measure the actual debt level of an economy. So this, if I had told you that 30 years ago that we have a debt to GDP which is above 1, that we have a very high budget deficit every year, that we have record deficit this year, and record low interest rates, you would have said, I need to go see a psychiatrist because this makes no sense. According to economic theory, you have either high deficits and high interest rates, and if you want lower interest rates, you need to lower your deficits, because in the end, the interest rate is the price of money that you pay to borrow debt. That's it. So the interest rate is the price of debt. If you have more of it, you have to pay more. This is economics 101. This is how it works. I have a lot of debt. I need to pay more interest rates, so that way I have an incentive also to lower my debt, to get my expenses in order, and etc. Now that is completely broken, and this is why the Fed last week announced the average inflation targeting, because we are actually the opposite now. We have record debt and we have deflation. We have prices coming down. Now I'm thinking about this, and let me be clear, I don't think this is a risk right now. I'm not talking about the immediate risk of a bond market collapse. I don't think we are at that stage. We might get there at some point, and that's why we at Orange Capital Partners are thinking about it today, because this could be an interesting trade. This could be an interesting signal to make money in the future. We don't think it's right now, because the Fed right now is going towards a spree of liquidity and support of the financial markets. This is what average inflation targeting actually means. It just means we're going to support you guys, go invest. Asset prices are going to be allowed to go up because they should be hopefully driving inflation in the economy. So having said that, we are trying to understand fundamentally from a first principles approach, what is the actual reason for this dichotomy of higher debt, high deficits, and low interest rates. It makes sense because it is what it is. So this is not virtual. This is actually happening. And by the way, it's happening in Europe, it's happening in Japan. And it's been happening in Japan for decades. So this is not something that we're just hypothetically throwing out there. This is actually happening. And we in the US are at the cusp of now going into the same process. And I think what Jerome Powell wants to avoid is a Japan scenario. So here's what I'm thinking is happening, and the way we think about this as investors, and the way we position ourselves based on that thinking, or the reason we position ourselves based on that thinking. And here's what we're thinking: that we have a large amount of debt in the market. Let me use an example. Let's say you have a building in New York City, which is, you invested $500 million in that building. You've borrowed, let's say, 400 million. You've put 100 million in equity. That building should be repriced to maybe 200 million, down 50-60%. This is roughly what my guess would be. You would find bids right now in New York real estate because of various reasons. It was overpriced. There's no demand. New York City is very unsafe right now. There's a lot of reasons to be very skeptical about New York real estate right now. And therefore, if you're a buyer, if you're an investor, you would see, like, I want to see a 60 to 80% sell-off, and then I'm happy to buy something. Now, of course, that would be great for us investors, for people who have cash and can buy. Problem is, a lot of people don't want that to happen. The people who are involved, the banks, the equity owners, and the Fed as a whole thinks that's not a good idea. So what the Fed is doing is telling the banks, listen, guys, you just roll that debt. Let's wait until that $500 million building actually really gets a 500 million bid. Real money, or as they say on Wall Street, outright money. So not some hanky-panky hedge fund, short-term, long-short, whatever. Real buyers who think that that price is actually a good price. Now, for that to happen, you have to wait. Time heals a lot of wounds. Maybe now the demand is not there and the price is 200 million, but maybe in 10 years it's 500 million. Who knows? This is, in my opinion, what the Japanese were doing. They were way overpriced in the late 80s, way overpriced in terms of real estate and all that. And they then did not let things adjust. So they basically avoided bankruptcies. And what they did is keep rolling the debt and wait until eventually at some point the prices catch up with the asset values and you actually get back into some sort of organic functioning of the economy. Now in Japan that never happened, and I don't want to analyze the Japanese economy here. I'm just saying it never happened. So this economy is still in a deflationary spiral as we speak. What Jerome Powell is trying to avoid with the average inflation targeting is exactly the Japan scenario. So he's stepping in right now and saying, look, we're going to be ahead of the 8 ball here, or whatever the word is. I think it's something like that. We're going to anticipate all of this and signal to the market that there is going to be liquidity, no interest rates rises, and all the other support that the market needs to keep growing dollar values in assets. Hopefully, at some point, that translates into the real economy also growing and in dollars, which means there is inflation. Not too much. The Fed doesn't want, average inflation of 2%. Doesn't mean they're talking about 10 double-digit inflation or anything like that. They're just talking about a little bit, a few percent here and there would be beneficial. I think to summarize, we're in a situation right now, I think a big regime change by the Fed, which is very supportive for asset prices. We believe risk assets will continue gaining in value, particularly growth stocks. We're questioning why there is this ability by the US financial establishment to have high deficits, high budget deficits, high debt, and also low interest rates, and the luxury that the Fed can drive inflation in the asset markets. Why is that dynamic happening? We have to think more about that. Our suspicion or our conjecture is that it has to do with the fact that our value creation in tech particularly is so high that the debt and the mortgage that we're putting on the future generations is actually not so bad, because the value creation we have through innovation and building of technology stacks in Silicon Valley in particular is so big and so dramatic that the actual debt that we're spending on things like healthcare and defense, which are the two main items that we as a country, meaning the US, actually are spending our budget, our government budget on, that those two items still are not as high and not as problematic as because the value creation in tech, particularly in Silicon Valley, is going to be much, much higher. This is our conjecture. We will think more about this going forward. This is also how we're positioning our fund. And this is how we see the next couple of years evolve from a macro perspective.